everybody. I'm Chris from Next Step Insurance, and I'm here to talk about marketplace tax credits and how that affects income and health insurance. This is really geared towards financial advisors and accountants and anybody who's just interested in learning a little bit more detail about how those tax credits work and how they affect you. I hope everybody can hear me and let me know if there's any issues, and we're going to jump right to it. I'm going to share my screen. All right, so welcome to the land of health insurance. Some of you are familiar with the marketplace and tax credits, or some of you may think you are, but I'm hoping you'll learn something new. I know even that it's been around since 2014. There is still a lot of misinformation, misunderstanding, and of course, with some of the new changes, there's even more. So I just wanted to make sure everybody's clear and understands how this works and how it affects income, your health insurance, what it means, what they're looking for. So just a little bit about me and my staff. I'm KRISTINA George. I am the owner, co-owner of Next Step Insurance. We started in 2020, Kevin and I, we merged kind of separate companies that were under the umbrella of Insurance Solutions into one company. So while we seem new, we've actually been around since 2013. Dorcas, George, and Paulette started, and then in the beginning of 2013, I joined in 2013, right to get in time with the marketplace and all of that entailment. It was a mess. It was crazy. And those of us who joined right away into the marketplace remember 1997 technology, even though it was 2013. I have become known as an expert in the marketplace. While many agents were jumping out and going, nope, this is too frustrating and weird, I was jumping in with both feet. And now I've become a person that agents across the country contact. And so that's why I really wanted to share this. I currently have 4 agents. We specialize in the marketplace since we have over 2,041 current clients. And then we have a Medicare department. We have 2,248 Medicare clients. So this is our staff and our team here at Next Step Insurance. At the top, we've got Ken. He's our pro. He's been doing insurance for a long time. And then there's David Marr, Justin Tomaszek, Kevin Stifel. That's those top 3 guys are the Medicare group. Joshua George, next over. Then we have Paulette Rominski, Samantha Nett, Wendy Harrison, myself, and the 2 in the front, Amber Dixon and Dorcas George. So as you can see, the 2 founding ladies are still part of the staff here, and not pictured are 3 other people. So we are currently 15. So this session is going to help you understand the exchange, the marketplace, ACA, income requirements, what is actually counted as income, the changes in the rules and the regulations that affect this year and next year, and understanding how the tax credits are calculated, and then know what qualifies as an HSA deduction and what does not. I know there are many accountants who try to help their clients, telling them to open an HSA account that they are not qualified to actually contribute. So I want to make sure that everybody understands. Health insurance marketplace. So this is a very brief overview. The Patent Protection and Healthcare Law of 2010, amended by the Healthcare and Education Reconciliation Act of 2010, which is now called the Affordable Care Act, was actually passed in 2010. And it took them, they gave the insurance companies and the world 4 years to get ready for it. The fall of 2013 was the first open enrollment. It started November 1st and it went live on 2014. The ACA has guaranteed coverage. There's no pre-existing condition being excluded. So you can have a very sick person go in on the 1st and they're instantly accepted. There's no rate ups, no riders are allowed, and there's an unlimited lifetime maximum benefit. I remember getting my insurance paperwork when I was younger, and I remember seeing $1 million was the max that they were going to pay. No more is that allowed. So there's no worry about somebody having an organ transplant who is never going to get coverage after that $1 million. It's individual and family health plans directly purchased from the insurance company. So the marketplace is just a one-stop shop to be able to see all the plans that are available. It's very nice to compare. You can see the prices and the benefits side by side next to each other. This is not government insurance. I still hear people kind of saying that. If you are on a group insurance with your employer and they pay for there's no pre-existing, and they give you free benefits for the preventative, guess what? You're on Affordable Care Act insurance. The Affordable Care Act changed everything, not just individual. It also changed group. So your free preventative, those annual physicals, mammograms, colonoscopies, those are part of ACA. So whether you're in group or buying it yourself, they're all the same. It is not government insurance. That would be Medicare. So who is eligible? Well, technically anybody can buy the plans, but only certain people can get the tax credit. So all age groups, 0 to 64, a child only can get this insurance. Now they have to be attached to an adult as well. But if the adult has, let's say, VA coverage and the VA is not going to cover their child, we can sign our child up for insurance. A great place to send your children that are turning 26. Employer-sponsored plans are just not offered at your work. Individuals between employment, maybe a 3-month probationary period. When you lose coverage, whether it's voluntarily or involuntary, if you lose your primary insurance at work, you can get this insurance. Early retirees, those people who think, I don't want to work till I'm 65, they can come in and get it. And you can get it if you're over 65 and not eligible for Medicare. Maybe you didn't have enough credits or you came to the country later and you're just not in the Medicare system, you can still get it. Now, again, anybody can buy it. If you're over 65 and you, for some reason, want to have this insurance instead of Medicare, you can get it, but you can't get the tax credits, which means it's quite expensive. So what are the marketplace tax credits? I've been using that phrase. Tax credits are calculated to help lower the monthly premiums of your health insurance. So the idea is, since you don't have a group lowering that premium cost, the employer isn't helping you, the government's going to help you and make it affordable. So that was really the whole purpose behind it, was to make it affordable. And it's called tax credits because it's the IRS helping pay. So what income are they looking at? How do they figure out what your tax credits are? Well, they need the MAGI, M-A-G-I, which is funny because I always think of magicians and rubbing the genie lamp, but it's the MAGI. And I know people go, what the heck is this? And they pull up their tax document and they go, where is that? It's not on your tax form. The MAGI is the modified adjusted gross income. So the adjusted gross income includes your wages, your taxable interest, business income, farm income, capital gains, unemployment compensation. I mean, all of the things that you pay taxes, that's your adjusted gross. Now, you can deduct self-employment expenses, student loan interest, contributions to your IRA, traditional IRAs, not Roth, moving expenses, health savings account, that's that HSA, alimony that was paid, domestic production activities deduction, certain business expenses. So these are the typical deductions, but that's it. That you can't have contributions to a nonprofit. That doesn't come off of the adjusted gross, as the accountants are shaking their head. Yep, we know what the adjusted gross is. The other income is what's important. So to calculate your modified adjusted gross, you take your AGI, the adjusted gross, and you add back certain deductions. Now, most of these deductions are not, they're pretty rare. The one that I've highlighted, non-taxable Social Security payments. That's the big one that people misunderstand. So maybe your whole Social Security isn't taxable, or you're doing your client and they don't have any taxable income because it's all Social Security. The IRS is saying, we're giving you money. So you have to count it. So even though it's not taxable, that's the modified adjusted gross. So make sure when you're helping with somebody figure out what is their income, what is that modified adjusted gross? That's what they're looking for. So changes to the ACA, the ones that have happened now and are going to continue into next year. So there's 3 changes that might affect your clients. The 3 very big important ones. The first one, no more income restrictions, no more holding your money back. Oh no, I'm going to fall off that cliff. As many of you know, that income cliff has been a problem. Now they're saying it doesn't matter. If your income qualifies you to get tax credit, it doesn't matter how much you make, you get that tax credit. So there's no more, I'm qualified, falling off the cliff. So that's why we call it the income cliff. That's only for 2021 and 2022 as of right now. The tax credit amount was increased. So in the past, it was 10% of your income was roughly the calculation, which I'll explain that a bit later. They raised it so that it would be 8.5, again, only for 2021 and 2022. But that did lower premium costs for those who already qualified, and it helped, particularly during this COVID pandemic, people who don't have as much capital money to use in their income, to help lower it a little bit more. And some people who were paying $100 now are paying nothing. They will get that money back when they reconcile at tax time. If their income that we put on the application is correct, they're going to get a very nice tax return. The other thing that happened for 2021 is any adult in the house of the two main adults that received unemployment for at least just 1 week, their entire household income was calculated at 100% of poverty level. So if somebody is a single person and they made $50,000, but they had 1 week of income that came from unemployment, the system is saying, we're just going to pretend that your income was basically 13,000. And so it doesn't matter how much, they're not going to have to pay any money back. Same with somebody, a couple of two. A couple of two's income is calculated at around 18,000, even if they made 120, and so on and so on. So this year, it's not quite waiving that tax credit that they have to pay back, but if you have unemployment, this is the year to take any money out that they might want to put in their savings account for future. It's not going to count against them as far as tax credit. Tax ramifications are kind of pain for withdrawals of IRAs or whatever, but this is the year they can do it without it affecting their premium costs. So who is eligible for premium tax credits? This is what I used to have to show. I'd have to go, okay, your income is between 100% and 400% of poverty level. You can't be more than, less than basically 12,760, or you go to Badger Care or Medicaid. You can't be more than 51,000 under any circumstances. And that was actually only in Alaska and Hawaii. In the rest of the continental United States, it was actually around 47,000. So this was what we used to have to worry about and try and keep people under that. But we don't have to worry about that income bracket. But the income is still based on household income. So it's not you can just say whatever and take whatever you want. There does seem to be people who think that, oh, it doesn't matter anymore, there's no income limit. Well, there's no limit, but of course, the more you make, the less the IRS is going to pay, the less you make, the more. And there is also no income brackets. I often hear people come in from their accountants going, hey, can you give me what the income brackets are? So I know they've been talking to an accountant. There's no income brackets. I can't say between 13,000 and 14,000, this is your tax credit. Between 14 and 15, this is yours. It doesn't work that way as far as the tax credits are calculated. There's a different thing that works, but not income tax credits. It's once you start getting a tax credit applied, you make 10 bucks, the tax credit goes down. You make 100 bucks, the tax credit goes down. So there's no income bracket. It is calculated. So where's that 10% or 8.5% calculation coming from? It's calculated based on the second cheapest silver plan in the county for that individual or family. So if somebody is 62 in Sheboygan County, their tax credit is going to be different than somebody who's 62 and in Ozaukee County or Fond du Lac County, or on the other side of the state. So it's very much based on where you live, the county, the zip code that you live in. If the rate of the plan is more than 8.5% of the modified adjusted gross, you get tax credit. So it doesn't matter where your income is, if that cost of that insurance is more than 8.5, you get tax credit. I've literally seen one person get $2, a $2 tax credit because the rate was already so close. If the plan is already less than 8.5% of that modified adjusted gross, you don't get tax credit. We've had some people go, well, that's not, complaining and saying it's not fair because they weren't getting a tax credit, but actually it is fair. Everybody is paying roughly 8.5%. Now, that's from the silver plans. That does mean there are bronze plans that are less than 8.5%. And there's gold plans and obviously silver plans because there's more than just two in a county that will cost more than 8.5. And sometimes it makes sense to take those higher expensive ones and sometimes it doesn't. And sometimes taking the less expensive makes way more sense. But on average, if you're trying to calculate for your clients, the future, how much money they need for health insurance, use 10% because I don't know if the 8.5% is going to last. Just say 10%. If you can afford to pay 10% of your household income for your health insurance, you can retire. So tax credits for those with the higher income. I'm using a higher income because we've never been able to go beyond like 67,000 for a couple. So I'm going to show you what that looks like. So here's our couple. One is age 63 and one is age 62. And it doesn't matter, male or female, the rate is the same. I'm putting their income at $105,104. So the cost of the bronze plan before, as you can see, no tax credit, $1,640. The bronze silver plan now, $374. Huge savings. The silver plan was over 2,000, now 744. That's that calculation. I used the second cheapest silver plan. The cost of the gold before, over 22,000, now is 1,000. So it's a significant savings, and they're making 105,000. So if they, I mean, that tax credit is $1,266 per month. They're saving $15,000 that they didn't have, that they had to spend last year. Somebody in the same plan last year had to spend $15,000. This year, that's how much they're saving. And I think that's pretty exciting. I am so excited to tell my clients, guess what? You now qualify for tax credit, and look at how much money you're getting. So to show you how it's different though, the same couple, but one is 62 and one spouse is on Medicare. So it's still a household of two, their income's exactly the same, but the tax credit is now only $248. So the bronze plan, 809, is now 561. A silver plan is 992, is now 744. The cost of the gold was over 1,100, now it's 872. It's not as big of a savings, right? 2,976 is not the same as 15,000. The reason for that is because the most expensive person on the plan, the one who was older, 63, 64, 65, is now no longer on the plan. So the rate of the insurance went down. But if you remember, the cost of the silver plan was exactly the same, 10% or 8.5. So 8.5% of the income, I got a calculation, it's 8,865, divide that by 12, 738. So there's my very rough calculation. The tax credits applied to the second cheapest plan, regardless of how many people are in the plan. So if I showed you a group that had 3 people, it would be 744. If I showed you another group of 5, it would be the same amount, or 1 person. So it's always going to make that silver plan the same. The other plans, because of the weird calculations and their cost, aren't as easy to predict. Bronze and gold plans. So bronze almost always cost less than 8.5%. If they cost more, there's no reason to be buying them. Gold will usually cost more than 8.5. There are some insurance companies who have actually made their golds cheaper than silver. I think Dean in Fond du Lac County a couple of years had their gold cheaper than their bronze. So it's usually though, there's always one cheaper silver plan because they use the second cheapest. So there's always another less expensive silver plan. So the fine print, this is read to all of our clients by each agent. The individual, if they sign themselves up, they have to click these. So I want you guys to see it, because if you've never actually gone through the marketplace and enrolled yourself, how would you know? So here's the fine print at the end of the application. I understand that because the premium tax credit will be paid on my behalf to reduce the cost of health coverage for myself and or my dependents, I must file federal income tax return for, this would be this year. If I'm married at the end of the year, I must file a joint income tax return with my spouse. Now, if they are living in separate houses, they're legally separated, they can file separately. It gets a little messier if we have children and dependents, but if they are legally separated, they don't have to file jointly. But if they're living in the house, they can't file separately. They have to file joint. They don't want somebody who makes $20,000 and a spouse who makes $500,000 to try and file separately. So one's getting a tax credit and one is not. And they must file their income tax. So maybe you had a client who doesn't need to, because they, again, live off Social Security and they don't even have taxes. They still need to file because the IRS needs to make sure that what the application was correct and the correct tax credits were applied. The second fine print, I also expect that 1, no one else will be able to claim me as a dependent on their 2021 federal income tax returns. We have to confirm this with our clients that come in. I'll claim a personal exemption deduction on my 2021 federal income tax return for any individual listed on this application as my dependent who is enrolled in coverage through this marketplace and whose premium for coverage is paid in whole or part by advance payments of the premium tax credit. So we really rely on tax accountants to tell us, or at least tell their clients, who is and who is not a dependent. I know enough about accounting to know I don't really want to be an accountant, but enough to say, all right, I'm sorry, but your 24-year-old that you're letting live at home who has a full-time job and has health insurance options cannot be on your plan. They cannot get tax credits for that. But then I had a man who told me he had 2 tax dependents who were in Mexico. Okay, I'm trusting him. He said that's what's on my tax return. So we do very much rely on tax accountants to tell their clients who is and is not a dependent. When we have a 23 or 4-year-old who maybe is going to college and the parents are trying to get them coverage for insurance, that's one of those things we have to really rely on. Like, okay, you can do that, but then you have to claim them as a dependent, or no, they're going to get their own insurance. You cannot claim them as a dependent. If any of the above changes, I understand that it may impact my ability to get premium tax credit. I also understand that when I file my 2021 federal income tax return, the IRS will compare the income on my tax return with the income on my application. I understand that if the income on my tax return is lower than the amount of my application, I may be eligible to get the additional premium tax credit amount. On the other hand, if the income on my tax return is higher than the amount of income on my application, I may owe federal income tax return. So that's where accountants are shaking their head. Yep, we know people have had to pay it back. And as you know, the IRS is not a prorated company. They don't care when you make your money. If you had $30,000 of income from January 1st to December 30th, but then on the 31st, you want $1 million, it doesn't matter. It's $1 million for the whole year. And that's the same with the tax credit. It doesn't say, well, the first part of the year you were making one amount of money and the second part you were making a second amount. It doesn't matter. So they do have to pay everything back for the whole year that they were using the tax credit. So if they only had insurance with tax credit for 4 months, they're only paying 4 months worth of tax credit back. But if they had it for all 12 months, they have to pay all 12 months worth back. Unfortunately, it's in a lump sum. A few years ago, as many of you might remember, the tax credit amount was astronomical. The rates of the insurance were so high that the tax credit amount was $1,000 a piece, even if they were making a little bit higher income. And if they were a couple of two, it was close to $20,000 that people had to pay back, 25, 26. So that's was very unfortunate. And there was a lot of people who misunderstood what was happening and took money out of their IRA and put them over that income limit. We here at Next Step Insurance, that those couple of years, I made very stressed out to my clients very much, do not go over this income. I mean, I think I only had one, and it wasn't something that they had any control over, but it was a large amount of money so they could afford to pay back. But we tried very hard. So that's where you heard a lot of people talking about, oh, I had to pay a penalty. It wasn't a penalty, you just had to pay back the tax credit. So paying back tax credits. So tax credits apply to the monthly premium for the couple that we had, $1,266 based on the income of $105,140. So if they report that income on the tax credit or on the application for their health insurance, but when they fill out their income was $125,000, then the IRS goes, well, your tax credit should have only been $1,125. That's a difference of $101. If they were paying the whole year back, they would owe $1,212. Reports an income of $135. Well, now the tax credit should have only been $1,054. Now you have to pay back almost $2,500. If you go up another $50,000, so you said my income was $105, turns out it's $155,000. The tax credit should have only been $912. They should have been paying the $354 themselves out of their pocket. They will have to pay back that $4,248. It's a fairly even Steven. It's what they should have been paying. Unfortunately, it's a lump sum as opposed to paying per month, so it seems a little harsher. But you also get it back. So again, you report $105,000 of income and you only report $95,000. The tax credit goes, oh, it should have been $1,337. Difference is $71. They give back $852. If you go to $85,000, now you're going to get back $1,700. And if it's really low, you jumped out, oh, I didn't take that money out of the IRA, or the selling of my house evidently was not taxable income. So you're reporting an income of only $55,000. Then they get back $5,364. So it's not lost. It's not, whoops, you didn't claim it. The IRS is keeping it. But I will tell you, income still matters, because I know there's probably some financial people, accountants going, oh, maybe I should have my clients estimate higher, right? I should, jump a little bit higher and they get this big money back. Now we're talking 105,000. Yeah, sure. Go ahead, estimate. But there are very big benefits if your income is low. So we have clients who come in that live off Social Security. All right, their income's low. We also have clients who have wonderful financial advisors who have helped them have tax-free income once they retire. And maybe they are living off Social Security, but they have Roth IRAs. They have lots in their savings account and other tax-free income. So those low income has some really big benefits. So the marketplace tax credit, as we said before, helps lower the monthly premiums. The second part of that tax credit and the income is a bonus benefit. It's called CSR, cost sharing reduction. So it reduces cost sharing by lowering the out-of-pocket expense for healthcare for individuals. It's the income between 100,000 or 100 and 250% above the federal poverty level. So what does that look like? So a CSR at the income of 250,000 above the federal poverty level, as you can see, the eligibility says the savings, which is the tax credit, is 774. If I put the income, if you see household income, I put 31,900. The one down below, I just added $1, 39,901. The tax credit is only changed by $1. But what does that mean? So as you can see, there's a little yellow CSR at the top, cost sharing reduction. Well, how that looks is the cost for both of these plans is very similar, $16.17. But look at the deductible difference. The one on top has the CSR, a $3,300 deduction. The out-of-pocket max, $6,800. The next one down, $7,000 deductible, $8,550 out of pocket. That's what the max out of pocket is for anybody beyond 250%, 250% above the federal poverty level. That's a huge jump. So if somebody came in here and told me my income's 32,000, I would put their income at 31,900. Let them have that better CSR, the $3,000 deductible instead of a $7,000. So they have to pay $2 back or $12 back at the end of the year. No big deal. The next bracket, here's where those tax income brackets come. So income at 201%. So 25,521, a savings of 837. There's your tax credit. Changing that income down by $1, 25,520. They both get those cost sharing reductions. But look at that. By $1 difference, their income can have their deductible at $3,000 or $400. And look at the out of pocket. It could be $6,800 or $2,850. So again, income really matters. And look at the cost of the premium. It's $0 for both of them. $0. So my client comes in and tells me they're making $26,000. Guess what? I'm going to put them down at $25,520. It's an estimate. They're going to pay $0, so they wouldn't even have to pay any money back, but their deductible is much more affordable for the price of their household income. We're not going to make them go broke. That's the point of the cost sharing reductions. And there's one more. So the next bracket is income between 150 and 100, well, it's 150 and that 200 percentile. So if you're below 150, I put the income at 19,141 and 19,140. As you can see, savings over on the right, $880 tax credit, same amount. It goes from a $400 deductible down to a $50 deductible. The out-of-pocket maximum goes from $2,850 down to $1,500. So again, I'm not trying to we don't want our clients to be broke. We're not going to have somebody who's 19,000 or 20,000 have such a huge jump because they only made, it's like they made $100 more and their deductible goes up by $350. So we pay attention to that here at the Next Step Insurance. A really good insurance agent, that's what they should be looking at. The premium is $0. They can go all the way up, I don't know if you remember, still $0. And that was at $25,000, not $2,500, $25,000, $520 income. If I put their income at 20 or 19 or 18, they're still paying $0. So there's no income that they have to pay back, no tax credit. And I know a couple of you are like, but what if they go over? Are they gonna have to pay back that deductible, those out of pocket? They do not. The insurance companies have no idea what the clients make when they file their income tax. So the IRS is the only one who has to get paid back. So if somebody comes in and says their income is 18,000 and they make 25, they don't have to pay back the difference of those deductibles. They just have to pay back if there's tax credit owed. So that, hope that makes sense. I know that's a little bit more complicated. HSAs. So here's my quick breakdown. An HSA is a health savings account. It's a tax-free savings account that can be used to pay for medical expenses not covered by high deductible health plans. You can contribute tax-free money. It pays for qualified medical expenses. It can even pay for most Medicare premiums. While you can't contribute once you are on Medicare, you can still use any money in the HSA, and it can grow as a very nice retirement nest egg, especially if you have an employer who's been contributing to an HSA or somebody who's young, who's been doing it for a long time. So that's an HSA account. An HSA eligibility. So in order to be eligible to contribute, you have to be enrolled in a qualifying high deductible health plan on the first day of the month. You have no other health coverage except what's permitted by the IRS. You're not enrolled in Medicare, TRICARE, or TRICARE for life, and you can't be claimed as a dependent. So the key word there is qualifying high deductible health plan. What does that mean? The federal government is the one who makes the rules about the high deductible health plans. There is a deductible that must be met before the insurance company pays anything other than preventative. So if they offer free telehealth, if they offer a copay to go to a regular doctor, it's not a qualified health plan. There are no copays. Once the deductible is met, whatever that's at, the rest of the costs are at a percentage. Again, no copays, or if it's the same as the deductible and max is the same, then the rest of the coverage is free. Lower max out of pocket than a traditional bronze or silver plan. So we saw that 8,550 high deductible health plans have a lower max out of pocket. So here's comparing. So the first one is Prevea 360 Bronze HSA, and then the second one is the Prevea Bronze Copay Plan. Cost is $807 and $780. The deductible, there's that big difference, $6,850 or $8,500. The plan on the left is a qualified HSA plan. The plan on the right is not. If you look further down, primary care doctor, after deductible, or a $60 copay. Specialist, after deductible, $120 copay. After deductible, $15 copay for generic prescriptions. That's the difference. They both have very high deductibles, right? And I know as an accountant, you might say to your client, how much was your deductible? And they go, oh, it's $8,500. Well, that is a high deductible plan. Go contribute to an HSA. That does not qualify. Just having a high deductible is not qualifications for an HSA. It has to be an HSA or a high deductible health plan that's a qualifying health plan. So it makes sense to enroll in an HSA, maybe if you're having surgery, hospital stay at the very beginning of the year, and you want to pay it with tax-free money. You know that you're going to be sick. You're going to have to pay a lot of expenses. Maybe you already have an HSA and you just want to keep contributing, or your client does, because I know my tax account every year. Hey, you're in an HSA plan, It's a great contribution. It's a great tax deduction. You had it in the past. I had quite a few people sign up to keep under that income tax limit. When somebody came in telling me they made $70,000, I'm like, all right, you're going to get an HSA plan. So instead of paying $1,200 for your insurance, you're going to contribute $3,000 or $4,000 into your HSA. Now your insurance is $400. So it was that was a way to reduce their income to a lower section, especially retirees who have a pension and Social Security fixed income that we can't have any other deductions from. And a younger, healthy client, tax accountants, if you've got those younger people and they understand an HSA and they're good about putting that money away, wow, they could contribute to an HSA for years and never pay out-of-pocket expense with any taxed money. When they're young and healthy, they can just keep putting that in and keep putting it in contributions. So HSAs are wonderful. But when it doesn't make sense, there's a zero deductible. So I'm comparing the bronze plan. So somebody comes in and they don't have any major things. They just want prescription coverage. They're not going to pay $807. They'd rather pay $832 and go get their prescriptions, go to their doctors for just a copay. If they've never been in an HSA plan, they don't want to suddenly jump at 63 into an HSA plan. If they have lots of doctor's appointments, but nothing major happening, they're going to save money in that zero deductible plan where they just pay a copay. And if they've never had an HSA plan, a lot of times, especially when they're retirees, the early retirees, it doesn't seem to make sense because it's something they've never had before. So key points to remember: ACA is not government insurance. It regulates the type of insurance that can be offered. Marketplace is just a place to buy health insurance. It's just a spot, like going to the marketplace to get all of your fruit and vegetables. It helps consumers compare prices and benefits in one place. There's no more income cliff for 2021 and 2022. Congress still has yet to decide if they're going to keep it that way for 2023 and beyond. We suggest people contact their Congress people to let them know they would love to keep that. It should stay. It's one of the things that should have been fixed a long time ago. Know your client's MAGI. What is that modified adjusted gross income? Tax credits are based on total household income, not just the person enrolling in the coverage. If the income on the application is lower than what is reported on the taxes, they will need to pay back the difference. And it's a straight difference. It's not a penalty. So please don't say it's a penalty. The penalty is no longer in existence. There was a penalty for not having health insurance. Now there's a penalty, but it doesn't cost anything. So please don't use penalty. It's not a penalty. They just have to pay back what, according to the IRS, should never have been paid on their behalf. HSAs can only be used as a tax deduction if they're enrolled in an HSA qualified plan and not just have a high deductible plan. So if you guys want to run your own quotes, you want to just see, hey, I'm going to run some of my clients, I want to see what's going to happen, run it for yourself, you can go here, healthsherpa.com/agent_ID equals KRISTINA with a K -George. Just go in there, you could punch in a zip code, hit see plans and prices. It'll ask for age because it does depend on your ages. It doesn't really depend on gender, but it makes you put one in. And then you can play around with the income and you can just see how that tax credit changes. It changes every year. So depending on what the rates of the plans are next year, we'll adjust that tax credit. But our same couple, regardless of the actual cost of the plan, is going to pay $744 for that silver plan. It doesn't matter. So if next year the rates are suddenly $2,000, the tax credit is going to be absolutely astronomical to make it $744. So that tax credit changes every year. If you kind of want to see, hey, if I have my client is going to make $70,000, and what would it look like if it was 75 or 80? Just use this. I promise you, even if you put a name in there, I'm not going to contact you. It's just a great quote tool, and it works well. And then you can even compare plans if you want to look. But if you're not if you're not a health insurance agent, I'm not sure why you'd want to look at all the difference in plans. So thank you very much, everybody. I'm Chris from Next Step Insurance. Put questions down in the YouTube channel. I will try and answer them as fast as I can. I appreciate everybody checking in, and thank you very much. Again, my name is Chris from Next Step Insurance. Thanks, and have a wonderful day, great fall, and happy and open enrollment.